So we were reaching the second chapter of our book after talking a lot about the topic of monetary policy and macro balance. Let's see everything from corporate or from investor point of view. So today I would like to talk about the first section, financial market structure. So what kind of segments can we identify and how are they operating? So usually we are using this segmentation in the markets. So for the short-term borrowing, we can find money markets. Money market is actually hardly underdefined because all other platforms like bond markets, like stock markets, or commodity markets usually in the hand of some sort of stock market, and they just have other market segments for bonds or for commodities like grain or oil or other stuff like this. In the case of money market, actually we can say that banks who are lending to each other, so interbank market can be considered as a part of money market. So it means that lending overnight or 2 weeks or 1 month can be categorized here. And also if banks are lending not to banks or other bank-like entities, but they are providing funds for investment funds. Or when, for example, a US investment fund had excess liquidity and they are providing it to European banks, then it's also categorized as money market. So it's not an organized market when we find the company name and so on. It's we are putting everything there, which is
yes. Money markets mean like when the banks lend money to the companies and to the other banks.
Mostly it's to other banks. So it's because companies are usually require loans for longer time periods than overnight. So usually what we can see here nothing. What we can see because this stupid thing is still not working at all. Let's hope that no. So if you are thinking about interbank markets, then we have usually there are country-specific interbank markets. So let's see Czechia. So PRIBOR. Okay, I was able to find a Czech city as well, but actually I'm looking for the interest rates here. So here, this PRIBOR says that this is the Prague interbank overnight rate. So this is a market average, and we can see, if I'm zooming in, that actually we have different terms. So 1 day, 1 week, 2 weeks, and so on until 1 year. So it's short-term lending. But it's also tricky because this interest rate is not an actual weighted average of loans to each other. Instead of this, because in the past when there was no internet and all other real-time data available, they used queries. So at the beginning of the day and at the end of the day or some specific dates, on each day, central banks are running a query to each bank that how much money or how much interest rate would you like to ask from other banks if you are providing loans for these terms here. But it actually doesn't mean that at the same time you have to provide this amount of loan at this specific interest rate. So it can be considered only as a benchmark. But if someone, like a company or a private citizen, takes up a loan from a bank, then usually they are saying that, okay, your loan will have the interest rate. In this case, in Czechia, that will be the PRIBOR, plus some other percentages, which represent your risk and the length of the loan and so on. But it will be based on this. So, and also many bonds are issued under these circumstances that they are following this market benchmark. And it's a country-specific approach. Also, we can find the same thing for Hungary. Usually, if something is ending on BOR, then it's interbank market-related issue. Once it's loading in, sorry, it's in English. Accept, understand, and that is my data. Yeah, it's not there. Whatever. So I just show you as an indicator that so it looks like the same everywhere. At least the table is in English. But you can see that, for example, 4 months, 5 months are missing here, so they are just a bit reduced, but they are collecting data on every opening days. So that's all. Also, we have a regulation for that. Yeah, so in this case, I mentioned that it's a quotation process, so they are asking, like a query. Daily submission of interest rates to the national bank by the panel banks. Interest rate is defined by the panel bank. Yeah, it's usually related to the domestic currency. After that, I will show you other examples when it's not just for domestic currencies, but usually for small markets, for small money markets, it's only for domestic exchange rates. And unsecured interbank loan, which means that there is no underlying security, so you don't have to give any kind of government bond as a collateral. Offer any kind of government bond as a collateral, or it's not a repo contract, it's just providing loan to each other. And yeah. So that's why in the past there were some scandals of manipulating the interbank market exchange rates, but not in Hungary, it was in London. So in many cases, when we are oh, come on. It's supposed to be maybe this one. So the London interbank market is when you can. Okay, this cookie requests became really strange nowadays. So at the Libor market, if I'm able to find them, yeah, so is ICA. It's not only listed in only one currency, but in all main or not that main currencies. Yeah, and we can see it here. So it's listed in US dollar, British pounds, euros, Swiss franc, Japanese yen, but also, if I know well, there is even for Hungarian forints or even small exchange rates we can find Libor rates. And as you can see, they are using also panel banks. So there is a short list of banks which are queried, and we can see it's not that much, but they are always taking out the lowest and the highest bids. So that's why it's hard to manipulate the Libor. Because if you are offering under the market average, then you will be skipped out. But still, there was a scandal in the early 2010s when the market authority realized that some banks were cooperating to increase the level of Libor, and later on they were punished. But if you are typing in Libor scandal, actually we can see some nice information about that. So, and still, actually, people are saying, so it also says Investopedia that in the next year, LIBOR may be phased out in favor of alternative rate setting systems, but they're always saying something like this. So, in the last 10 years, if I'm able to see that they are phasing out and the alternative works, then okay, but come on, it would be easier not to cheat. So the system is working well, usually. I would like to show you some data, just some, for some reasons it's not there, but all the quotation and so on is available on the website. Reward data. Okay. I would like to show you some nice numbers, but at least global rates can provide us something. And in this case, we can see that it has the same structure just for different exchange rates. So Japanese yen, US dollar, 1 week, 1 month, and even for euros. Maybe they have it bigger size as well. Yeah, so we have completely the same maturities like in the small ones, just also in major currencies. Swiss franc. And obviously we can ask the question that is this similar, for example, in euro, because for euro we have the LIBOR in euro, and also we have the Euribor, which is the official benchmark for the Eurozone. So let's see that they're supposed to be similar, because otherwise there would be an ability for risk-free trade, and market participants would jump from one market to another. Okay, now it's operating. And so there would be arbitrage between them. So let's see that it's minus 0.5. It's a bit different. So practically we could say that, okay, if I'm taking up a loan at Euribor for 1 week maturity, then I can invest it elsewhere and I can live from the interest rate differential. But right now we can see that all of them are negative, which is horrible at the same time. So it's actually it's a complete market failure that we have negative interest rates. It's supposed to be at most positive. So even if you are reading any kind of books about monetary policy, it says that you cannot have negative interest rate because it's counterproductive. And in the last 10 years we are living in this. So we can say that. And it's only for euros. So if you are switching to US dollar, it's at least positive. It's 0 something, but it's positive. For Japanese yen, I'm not sure. Yeah, it's negative. Swiss franc, it's absolutely negative. But in the case of Swiss franc, it's obvious because they would like to push out excessive capital inflows. But in euro, it's actually killing banking system. So it's not that good. Okay. And also in the case of the money market, international lending is also happening. That, for example, in the US, there are money market funds. So later on I will talk about investment funds, but actually money market fund is like, they don't have a banking license, and they are not collecting deposits from clients. So they are issuing bonds, or they provide some sort of an ownership in the fund. So people should purchase some securities which are defining that they are participating in the investment fund and how much money did they invest. And after that, these money market funds are going to the money market and they try to lend money to the banks on the interbank market under these conditions. Okay, right now we can say that it's absolutely not favorable to go anywhere to lend to this money on any kind of money short run to European banks and euro basis, because come on, you have to pay for that. So it's bad for business. But in the case of US dollar, it's still popular to do that. Obviously, the interest rates are not big. So you are living from really small margins here, but it's still there. So you can do it. So in many cases, when banks need short-term US dollar liquidity and they are in the Eurozone, then they are just going to this money market funds instead of going to another bank. They are the main source of liquidity nowadays. Even I can show you a nice article because we are working on this for weeks now. So I hope that it's here and downloaded. In the literature. Yes. International bank lending channel for monetary policy. Maybe this. Yeah, no. This one. So the BIS, Bank of International Settlements, have really nice working papers because many people who are working at the central bank, usually they have the chance to have a scholarship and to work at the BIS for 1 year and to do research there, and that's why they are publishing really nice articles. So we can see that actually, if you look on the data, that this is absolutely not bank-based lending on the financial markets in US dollar. This is how money market funds are distributing their US dollar collection to foreign banks, like banks in Japan. This is this black line, or banks in Canada. This is red. For me, it's red, and all the others are European banks. So we can see that it's huge amount of money. So it's 2.5 trillion US dollars. So it's and after that, when we are not thinking about this short run markets, then we have the capital markets, which are much more medium or long term oriented, at least from an issuer point of view. From the point of view when you want to take up or collecting the capital, if it can be a debt or it can be ownership, or shares. But let's see the bond market. So you know the bond market from the yield curve concept, when everything was, if it's a bond, so it's issued on the market, it has a maturity that somewhere expires at some time in the future. It pays some sort of interest. Sometimes it's not even to pay an interest. So short run bonds are usually just issued that we have a pair capital, let's say 100 US dollars, and then the market will price in the actual interest rate inside of it. So investors will purchase it under the pair value. So they are giving just, let's say, 95 US dollar for this bond, and after that we can say that okay, it's 5% of interest rate, what is offered here, but actually it's yield. But we can say that it's something like this. So usually vanilla bonds have this structure that they are issued at a par value. They have an interest payment, but also they are usually traded with some sort of discount under the par value, so market price is under that, and their maturity can start at 3 months, and actually it can go to eternity. So there are some countries in Europe which were issuing bonds with the maturity of maybe 50 years several years ago. So usually Germany is able to do that. For example, Hungary, I don't think so that it's able to do that, but that's usually. Oh no, term structure of German. Because it's can be also interesting. Yeah, just here is only for 1 year till 30 years, so it's not that long, but I know that several years ago they issued really long, so it's for half a century long bonds. Because if you are able to issue it, then why not to collect people's money for that? If they are purchasing it, then you are happy to finance yourself. There is nothing more. No. Okay. So bonds are about debt and about long-run debt, but I also mentioned that here is what matters is that what is the term structure, so when the money will expire. So again, it's much better to show. So if you are saying that this is the entire public debt, bonds, usually it's in bonds because why can take up bank loan from a bank, and we can say that okay, this will expire this year. Then this part will expire next year. So 1 year later, then we can say that this is for 2 years. We can say that it will be 3 years, 5 years. People prefer to issue things for 10 years, so let's do more. But we have 20 years, 30 years. And let's give some colors for that, because coloring is a nice thing. So actually, why is significant is for us because it's way easier to manage such a scattered public debt, because okay, this expires, then we are issuing the same amount of government bonds this year, and then we can maintain this. Usually the problem is when you have the term structure of something like this, that this expires this year, and maybe you have something for next year, and then 3 years. So if you have the term structure like this, if you are a company, then you can survive because you can go to banks. But if you are a country, then this is high way to go to default within several years. So Actually, there were cases in Hungary in the early 90s when still we were changing everything or the institutional background to market economy. So mostly we were funded by the IMF. So usually a public that looked like this, that something like this was the IMF funding. Later on we will talking about IMF and how it works in the last part of the semester, and actually the rest was short-term bonds. So because actually they were not able to issue bonds with longer maturity because nobody would like to purchase this since all the institutional instability, high inflation, depreciating currency, so who needs that? So that's why we have IMF to maintain public debt funding. But after everything was consolidated, then they were able to issue longer and longer bonds. So, so that's why bond market can be highly special for us. And also we can think about the premium. So if you are thinking about that, okay, but what is the difference between countries, then I can show you this thing as well because it's from an article 2 years ago. This is just for the Eurozone. So they are just long term, so it's 10-year maturity government bonds for different countries in the Eurozone. And we can see that, yeah, this is Greece. It was terrible. The data is, I will increase the size because you can't see because it's just 10. Now it's visible, just the countries are too big. I will decrease their size because it's not that significant to see them. Okay. So we can see that until there is no market crisis on bond markets, usually countries, at least in the Eurozone, but usually if they have the same risk rating or at least in the head of the investors, they are categorized to be similar. So there are no individual stories that, oh, what is happening in this country, until they are completely boring, usually yields are the same. But once something terrible is happening, so let's see 2008 September when the crisis hit, two small Baltic countries, Latvia and Lithuania, their bond prices suddenly jumped in the skies. And they needed austerity and cut back all the expenditures in the government, and they had to cut also pensions and so on to reduce the budgetary deficit. We were learning in the last part of the semester about this. So they were able to consolidate themselves. But after that, we can see that other countries starting to fall out also from this really homogeneous mass of yields. So this is Greece, for obvious reasons, because if you are cheating with your budgetary numbers for 2 decades, at least, and suddenly market realizes that your GDP is not on that side, because it's smaller in real life, and also your tax incomes are actually not realized in full percentage, just partially, but you have expenditures, nice expenditures, then the willingness of funding this thing will disappear. So we can see that at the peak point, if they were issuing a government bond, they were able to collect only 70% of the capital of the pair value. So yeah, it was a highly disaster. European Union had to spend a lot of money. Actually, they did not have to spend a lot of money because at the end of the day, it was funded by private investors. Just yeah, it was a really special case. We have a really nice paper about that, so if you want, you can read it because it's available in English. Just I have to. It's much better to use the website. Oh. There is a Hungarian website to collect all publications, and it's loading in. International Journal. What? Okay. There is foreign journal article in foreign language. I can understand that. Hungarian journal in foreign language. I can understand that. Hungarian journal in Hungarian language. But now they created a new category. Foreign journal in Hungarian language. Come on, outside Hungary, who reads Hungarian language? Nobody knows this language at all. So, okay. So not that one. What is this? This one is missing. Okay. Come on, it's why it's in Hungarian language only. Whatever, I don't want to pay it, just there is, I will link it to the post page that there is a story about nice paper about this issue, that how European community tried to avoid going to default. And actually you can see that once this heterogeneous point of view disappeared from the market, that market became, it was calmed by actions by the European Union, then actually this heterogeneous view disappears. Just the problem is still there's this cherry picking that, oh, I don't want to purchase Greek government bonds because they are rubbish. Okay, I understand that. But I don't want to purchase Spanish government bonds. Then I cannot understand that. But there were periods when market participants did not like that. And in this case, I will purchase only German. So, and it's really dangerous because it can harm markets. So bonds are special, but also at the same time we can say stock markets. So in the stock markets, so first of all, we have to realize that a really small segment of the corporate sector is actually listed on the stock markets. So it's a really narrow part. There is also a good paper about it. It was published by the National Bureau of Economic Research in the US. I think that was... I met this guy once. Yeah. At a conference. He was a real researcher, so he was fat and so on, and bald and had glasses. So, and actually they were writing and publishing this paper because even in the US, the number of public listed companies are decreasing or they are stagnating since 2000. And after that, they were analyzing this. Maybe if I'm going back, then we can see that this is the number of in thousands of the listed companies in the US. So it's around or fluctuating between 5,000 and 8,000, and globally elsewhere it's 4,000 something. But still, if you are looking on that, it's a small amount of companies who are listing themselves. So usually, if you are looking on stock market indices, we can consider it much more as a benchmark. that how valuation of the corporate sector changes in the head of the investors. Because mostly it's about expectations about their cash flows. So, let's see. So usually when we have to think about corporate valuation and values of shares on stock markets, actually what we are thinking is that, okay, we have next year and after that 2 years, 3 years of profit, 4 years, 5 years. After that, I don't think it's rational to have expectations on stock markets. But at least we were able to earn something here. So it should be a cash flow, but positive cash flow. It can be negative, just in this case it's decreasing the value. And also assets in the fifth. So if we would close the company down in the end of the 5th year, then what would be the value of their shares? And then altogether, we are calculating the present value of all these cash flows. So CF here, CF there. It's not equal, but it's supposed to be similar to present value of future cash flows and assets. We have to distinguish the assets because actually we have to say that, okay, if we are closing down the operations in the 5th year, then we can sell all the assets, all the buildings, all computers, the lands. They have some cash reserves, so we can liquidate everything what is in their hand, and then we are paying all the debt from this. And still, if we have something, then it will be valued here, and this will be part of the corporate value. So once we had to value in a company which had absolutely no debt, just the shareholder wanted to sell it, and actually the company was in losses, so we were able to see that the cash flows were completely negative and they were decreasing, so they were losing market and they were dead, so they were just bleeding money. In this case, we have to say that now you should not value this at all. Please close down the entire operations and take what is there on the assets. Because still the company had some 50 million forints, they had some land, so that was a liquidation case. It was really sad because still some people work there, just you can't say that, oh, you can sell this company, nobody would like to buy this. So actually this happened several weeks later that they were not able to maintain the operations. But it's also really tricky to have expectations about future cash flows. On which purpose? Because until it's a simple company, so let's say you are a warehouse. You have defined square meters, you know the square meter prices to be let or to be rented on the market, and after that you can see the competition. Maybe you can describe some demand curves on the market based on past experience, or you are just thinking that, okay, it will be continuously the same, like 70% of the entire warehouse will be always rented. And after that, you can easily define the future cash flows. At the same time, if you have a debt, then you can estimate that, okay, what is the expenditure and income structure of the company, and then we can have something here. But what is also really tricky, that, okay, it's really nice to say that we have a present value, but present value is always related to the division. So we have all the cash flows here, and as during the next semester you will learn from corporate finance, there is always a 1 plus R on T division here. So actually you have to have an interest rate. And if the interest rates are going down like nowadays, or during the last several or now decade, actually it means that the amount of future cash or the present value of future cash flows will increase rapidly. Because this is how mathematics works. So actually that's why I don't like when central banks are keeping interest rates low for a long time, because it creates enormous increases in stock value. So if you are looking on Stoku, which at least works, SPX for Standards and Poor's 500, then we can see that, come on, stock markets are still increasing. But partially it's not because companies are realizing higher and higher cash flows in the future. Maybe some of them, yes. So we can find, okay, Tesla is growing, but still they are in growing phase. So mostly what we can price in is that in the future they will have some positive cash flows which are higher than today. And they are in the exponential growing phase still, because they are building the new factories, they are still introducing models, they can still cut back the prices of the batteries. So yeah, they are growing fast, but we can still find companies which are just existing there and their value is growing because of present value calculation, of discounting. So I can say that, oh, this economy is much more stronger today than it was before in 2000, because at the same time, if you are looking on the GDP, global GDP, do we have something like this? I mean available as function? No, then let's say US GDP. Yep. So actually still we can see that, yeah, it's growing nicely. Just maybe it's too nice sometimes. And also we have to add these assets here also with present value. But you will have many of such calculations during the next semester, because this is what you will do for corporate finance to see that. And also it's summing up the cash flows. So what is also really important here that so stock markets are valuing in the future, not the past. So maybe the company had really successful history in the past, but it doesn't matter from stock market point of view. They are focusing always on future relations or issues. So yeah, commodity. Commodity market is also different, because in commodity markets, actually, you are trying to deal with the supply and the demand of something. So, if we are I will close down some tabs. We can keep this, not that one, not that one. Okay. Futures. Oh, no, it's index futures. Sorry. Commodities. Obligacje. No, it's bonds. It's a Polish website, just it's free of charge. Towary. Yes, I was able to find that. So, so usually on each, I'm still trying to load in the Thomson Reuters database. It's nice to pay a lot of money for this when it's not working. So usually forward markets, or sorry, future markets are about commodities, because you don't want to sell instantaneously a shipload of crude oil immediately, because you are not delivering at the same time. So that's why first of all, we have to distinguish between two platforms. One is spot market. When you are giving the money, you are signing the contract and delivering the product at the same time. And also, there are futures and forward markets. Future markets are market-based platforms. Forward markets are defined by banks, but mostly futures are transparent and everybody follows them. Forward markets is just a segment under this. But in the case of future markets, right now you are signing the contract that you have to pay and deliver in the future for a defined amount of quality and defined amount of quantity of goods. But this delivery will happen 1 month later, 3 months later, and so on. So in the future, not far future. So usually you can have contracts only for 1.5 years ahead. It depends on the market and the underlying asset, but usually this is how it looks like. So we can see that usually it's about energy, it's about metals, grains, soft, cocoa, yeah, that's best thing in the world, and orange juice, it's also a nice thing, and fibers and even meat is there. So, and it can be also considered as a benchmark. So maybe many farmers are not selling their orange juice on the futures markets, but if they are making a contract with someone, with a factory, then usually the contracted price will follow the futures markets. So it's interrelated. So, and I mentioned supply and demand. Obviously, in the case of oil markets, it's just for this like this. Okay. So here we can see that actually oil is really tricky, because on the supply side, yes, we can see that oil fields which are pumping out oil from the ground, and they are available and they are not disturbed, and the pipelines are intact and so on. But on the demand side, actually we can find all the macroeconomic aggregated demand. So if macroeconomic aggregated demand is decreasing, then oil prices are decreasing suddenly. So we can see here that was this demand shock. Also, this is COVID effect. And actually the entire 90s was all about really cheap oil prices. So I remember I was in high school in 1998, and I was listening to the radio that common oil prices were reaching $10 per barrel, and come on, it's that time, that was the period of the Russian crisis, when Russia went to default, and IMF and G8 countries had to bail them out. That was the end of the Yeltsin era and all the anarchistic period of Russia. So after that, then we can see that all these periods when China was growing up and all the emerging countries were increasing, so suddenly the global demand was increasing towards energy resources. So we can see that it follows this thing. What is interesting that, okay, for oil, commodity markets are highly globalized. Actually, it's still not that globalized because for different type of oils, you need different type of refineries. So, for example, in Hungary or in Central and Eastern Europe, all refineries were built up to refine Russian kind of oil because of sulfur content and yeah, stuff like this. So engineering reasons, but actually you need different infrastructure to refine crude oil from the Nordic Sea, so what is coming from Norway or England and so on. And also you need different refineries to refine, for example, oil coming from the Middle East. So there are many different types of oil, but actually we have some benchmarks. So usually everybody uses Brent or WTI, which is a US definition. So we can see that there is a WTI, there is Brent. This is palm oil, so it's not a thing. And actually coal is much more interesting because coal is absolutely a local or regional product because it's not okay nowadays. Maybe coal is still worth enough to move it from Australia to China, but in the past it was not that common to move coal because it's usually available everywhere. So yeah, and also for gas, natural gas, actually it was following crude oil prices many years. Now it's less integrated, but in the past it was also highly integrated. When this integration disappeared in 2007, actually Merrill Lynch was losing lots of money. So it was billions of US dollars when they were bidding on this, and yeah, it did not end it well. And of course, for companies or for banks or for states, financial markets are always used for asset financing. So you want to purchase some asset, it can be a highway, it can be a building, and that's why you want to raise capital, and you are looking for owners. In this case, you are going to the stock markets, or you would like to collect debt, or you would like to borrow money, but you don't want to go to banks. You are going directly to stock markets and collect something. And of course, there can be risk management purposes that you want to use this markets as well. So that's why the second section will be dealing with all this fancy stuff like futures, options, swap agreements, CDS, securitization. It will be terrible, but you have to learn this because you will be economist. Then, other topic. So how wire transfer works? Because usually we are taking it granted, or in many cases people are saying that, oh, this is the territory where that is blockchain will appear and maybe blockchain can make things more standardized and more easier. Because right now, okay, I can't say right now, but during the 90s, for example, transferring money from one bank to another, it was taking sometimes even a week or several days before the internet. Or when they had already some phone lines, or fax machines, but it still was mostly paper-based. At the end of the day, they had to generate some papers on it. And at that time, if they would introduce these blockchain systems, I would like to say that, okay, it's highly rational to say, because in the case of blockchain, actually you are generating a standardized query with all the data inside, and then you cannot falsify this because the entire blockchain is about to keeping the information and just add new blocks to the system, and you can't begin because the entire network is maintaining the integrity of this blockchain. Nowadays, it's harder to say because if you are sending money from one bank account to another bank account, there are many different agents. So gross settlement systems are saying that, okay, we will collect, they are creating a matrix that we have a relationship with bank 1, bank 2, and bank 3. So it can be, let's say 3, it can be -2, it can be 6. And also, this is just for, no. Okay, from bank 1 to bank 1 it will be 0 because otherwise it would be stupid. But for example, for bank 2 it can be 4, it will be 0, -3, 0. So in these gross systems, actually they are collecting these positions until a predefined time. So it can be midnight for many countries. Even in the 2000s, it was just midnight, or they are able to increase the frequency to say that every hour or every 5 minutes or something like this. But they are still collecting the offerings, and then they are just saying that's why it's a gross system, because they are saying that, oh, okay, let's sum up the entire position. Is 4. So actually bank 1 should provide the clearing house for units, bank 2 should provide only 1, and bank 3 should provide 13. And then they will sort it out that where the money goes. So it's cheap, the benefit of this thing, because you don't have to move all the money around because you are just collecting the money that should be moved around. Obviously, if it's a net settlement system, which is much more modern, so this is like the Viber in now, yeah, it's Viber because it's a real-time system, but it's also called in the Eurozone is the Target. Well, now it's Target 2. That they are collecting or connecting all the real-time settlement systems. In this case, literally they are settling to each other. It doesn't matter that what is the overall position. It makes everything trickier because usually it's limited how much money can be transferred, because otherwise it would disturb the liquidity position of the banks. But usually it's closed away from retail clients, or after some transfers you can do this because they are more expensive. Credit card payments are a bit different, because in this case, if you are using the POS terminal, then actually you are sending the money to the card company, and also at the same time the card company will deliver their money to the shop, for example. But you know that, for example, if there is a case of fraud, then they can take it back. So they are paying, but not paying in some cases, because at least there is the opportunity to withdraw the money if there is something troublesome happens. This is not the case of real-time transfer. So if a real-time transfer something wrong is happening, then the other guy still can be asked to transfer the money back, and legally they have to. So it's not mandatory that, oh, I got some money, then I will spend it, and who cares? But it was not mine. But in this case, they allow to take it back. But obviously, because they are building up all the infrastructure, it requires more money. So usually fees are bigger for card payments. So that's why shops usually don't prefer them. And actually, there are huge differences among countries in cash preferences, even inside the European Union. So in the case of Germany, and especially South Germany or France, cash preference is around 70%. So you can do many things only with cash. But it's really funny that if you go to Denmark, to Netherlands, that even you can pay with debit card at a toilet, at a public toilet, that I would like to go in and don't have euro coins. Who cares? Pick, and then you can go in. But also in Netherlands, I was able to see that they are selecting among credit or debit card companies. So, for example, in many small shops, they were just accepting Maestro card. So I had the MasterCard, my wife had a Visa card, and we were even using my free of charge debit card from Maestro, which is completely considered as useless in Hungary, but so everybody accepts this, and it has no special ability, but there it had. So it's really strange that how different can be actually the attitude towards card usage or cash-free payment, even between similar regions like Germany and Netherlands. Swiss system it's actually for foreign transfers between foreign countries, and it connects banks together. So it's like information system among banks. I'm not sure that how long this will exist, because nowadays it seems a bit outdated, but yeah. So each bank has its identification code. I think, actually, to be honest, I'm thinking that this thing could be switched the easiest way to blockchain based, because right now we can say that okay, we can take out any kind of bank from the Swiss system or any kind of country from the Swiss system. You can't push out anyone from the blockchain system because the market is not structured, or the infrastructure is not structured this way. And also there were some scams with the Swiss system by hackers. So it means that blockchain could also defend transfer system against such frauds. And we have a last concept. This is the clearing house. So the concept of clearing house was created in the 30s after the Great Crisis, first Great Crisis, and it was based on that, okay, if we are trading on commodity markets, and it says that, okay, I would like to sell some grain, it's March, and I would like to deliver in May, and let's say that, no, sorry, payment will happen at the same time here, but this is client 1, this is client 2. And we know that this is an obligatory contract to have the futures. So you have to deliver, doesn't matter what, you have to be there, otherwise you declare bankrupt and you will be unhappy. So, to avoid this thing that, okay, we are signing the contract now in March, but after that I have to deliver and the other client should pay. So as a result, we were asked to put some collaterals. So actually, the case of collateral deposit, as a collateral. Yes?
Both the client will put the collateral.
Actually, and this is the tricky part, because usually if you are looking on the literature, it says that 3 to 12% of the underlying contract value. But it completely depends on on the brokerage company. So usually it's asked by the brokerage company and then it's given towards the clearinghouse. The clearinghouse is always operated by the stock exchange. Well, usually it's owned by the stock exchange. In Hungary, this is the Keller, which is a separated legal entity, but is still part of the stock markets. But my problem is that actually this contract value, so how much money should be kept there, it depends on the volatility of the market, it depends on the brokerage firm, it depends maybe on the external temperature. So there is no predefined function to describe that, okay, this will define the collateral. So usually it's called as a margin. So you start the entire contract with an initial margin. That you have to put it there. But if volatility increases on the market, so everything became a bit riskier, then actually they can ask for further maintenance margin. And if you are not able to provide more deposit or to increase your deposit, they can close down the entire contract, or they can reduce the size of the contract. So then this can happen, and yeah, there were ugly things about this. So for example, there was the long-term capital management scandal. Long-term capital management fund was an enormous hedge fund during the 90s. So it was funded by all the guys who got Nobel Prize for inventing option pricing in the 70s. They got their Nobel Prize in the early 90s, maybe 1992 or 3. And then they've created their own investment fund because they were responsible half of the global option market in the 90s. And mostly there's really complex financial products, but at the end of the day, in many cases, they were using forward or future contracts like this. And the problem was that once the Russian crisis started to hit the market and the volatility started to increase, actually their financial service providers started to increase the margin size. And it meant that if global volatility was increasing by 1%, they had to put an additional $100 million as a deposit. So soon they were running out of money. So sometimes it can be shady, at least for me. How margin is computed. But it's still necessary to use this because it stabilizes the supply and demand side of the markets. Because if someone disappears or someone goes to default, then in this case the clearinghouse can step in and deliver. And before margin requirements, actually you were able to create any kind of contract. So there were scandals in the US in the late 1880s that some people had future contracts for an entire month of grain delivery, and it was obviously a scam, just the market regulations allowed that. And after that, he suffered from that because some people collected enough grain to fulfill his needs, so he went to default. But so at least margins are limiting the sizes of the contracts. Just you have to be really careful. So if you are making any kind of contract related to margin, that what is the limitation of margin, and you have to have some extra cash to maintain your position because